So I'll cover the first homework assignment for 2011. And first question is on interest rate. So the question is basically, you're considering buying a car. The car costs $30,000 even. Don't worry about tax or anything like that. And you have two choices. You can finance the car by buying it, putting down $5,000, and taking out a loan for $25,000 for 3 years with 5% APR. The other choice is you can lease the car, and the terms are put $2,000 down and pay $199 a month for 36 months, but then you turn the car in. So it's asking, the question is basically which way would be better from a risk-neutral point of view. So you can put the money down, and any money you don't use at any point in time, you can put in the bank and earn 3% per year. So there's probably two ways of calculating this, but one way is to figure out what your monthly payment would be. Then based on, it'll be a bigger, like an Excel spreadsheet to figure out what our future value would be, but this is how much money we'd be paying in future dollars. And then the future value of choice B would be, this is how much we'd end up paying. So in the future, if you subtracted this number from this number, you would get how much more the person who bought the car had paid over that much time. So at that point in the future, if the car was worth this much money, that would mean the two people approximately broke even. Obviously, there'd be the headache of having to sell the car or buy the car if you didn't have the car, or sell the car if you wanted to get rid of it, but that would be the price that you'd be looking for. So in this case, these numbers aren't really realistic, because usually the leasing option, usually the car ends up being worth less than if you leased it. So in this case, in other words, what I'm saying is this is a pretty high number. It would be a $30,000 car after 3 years of use might be worth, what, $15,000, half price, or a little more than half. And that's approximately where the lease versus buy breaks even. So then the next question was on a just a random cash flow. So basically saying some money's coming in, money's going out. Again, this isn't an investment because the signs of the cash flow keep flipping back and forth between plus and minus. If they started out minus and switched to plus, it would be considered an investment. So we're trying to figure out what is the implied interest rate of this cash flow. So what we can do is we could do it again in present dollars or future dollars. Either way we could figure it out. And the way we're doing it here is we're saying that we're taking the amount coming, it's basically all these numbers are being calculated in present values. So the $10,000 today is equal to $10,000, 1 plus the interest rate raised to the 0. Then the plus 2,000 a year from now has an exponent of 1, minus 3,000 has the exponent of 2, so it's 2 years worth of interest being added to it. And then add this all up and you set it equal to 0. When you set it equal to 0, then you're saying what interest rate will give me a return of 0. And that's how we'll figure out what the interest rate is. And then you could do this using GoalSeek in Excel, or just have a box in Excel that for R and just keep trying it until it hits 0, if you're not familiar with GoalSeek. And then your calculators can do that too. So eventually we find out that the implied interest rate is 0.024277. So pretty much any cash flow you could come up with has an implied interest rate. And it's just a matter of solving for the interest rate by calculating either against present value or future value. We could have figured this out, what all these numbers equal 5 years from now, and also ask ourselves what interest rate would get us there. So that would work too. Okay, so now this is a question that's basically, it's taking the same concept we've learned, where now you're owning percentages of an investment instrument. So instead of, you could kind of think of this as if you were able to buy a percentage of a share of stock, but basically we're buying a percentage of a share of something. So this question is saying, you've come up with a great idea for an app, it's gonna take you some time to develop it, you have to rent some office space, buy some servers, hire some people, so you need money to do this. And a venture capitalist comes along, that's somebody who will give you money to develop your idea, and they're saying, let's see, the venture capitalist doesn't want to be paid back, so they're going to do what's called investment banking. They're not lending you money and you pay it back at a specific interest rate, they're lending you money so that they own part of whatever you become. That's called investment banking as opposed to just standard banking. So the investment capitalist wants to own 40% of your company and will give you $5 million. So at the present moment, what does the what does the venture capitalist think your company is worth? Well, if they're giving you the fair market value, then for 40% of your company, they would want $5 million divided by 40% would mean they believe your idea at the moment is worth $12.5 million. So they're calculating that's the highest they would end up giving you for 40% of your company, and maybe you're thinking that's the lowest you would take, and you met in the middle and cut this deal. Okay, so then how much would your company need to be worth 3 years from now for a risk-neutral venture capitalist to have broken even? So the person is giving you $5 million today and wants their value to go up at least with the rate of interest. So there's probably two ways you can do that. You could take, one way you could have done it was to take $5 million and add 3 years worth of interest and then divide that by 0.4. And the other way would be to take the current value of your company, make that go up to, add 3 years worth of interest onto that, and that would be the value of your company. So wait, I'm sorry, the question's asking, what would the company need to be worth? Okay, so yeah, we would take this number that they need to get to. I'm sorry, this is the current worth of their company as they perceive it. Add 3 years worth of interest, the net worth of your company should be $14 million for them to have broken even with the interest rate. Okay, and so this is a common thing. After a certain number of years, the money you've been using to develop this product runs out. You might go back to the first venture capitalist and say, can I have more money? And then they would want to own a bigger percentage, but they might say, I'm done feeding this, I'd rather someone else bring money in. So you go shopping around for a second venture capitalist. And another one comes in and says, let's see, the second one comes in and says they'll give $4 million, but they want 30% ownership of the company. So the first venture capitalist in this case stayed at the same percentage of 40%. And then the new person took their 30% out of you're the owner, so it would be out of your ownership. So the question ends up being, who got a better deal? Which of the two venture capitalists got a better deal? So there's really no right answer to this question. It was kind of, the question is designed that way. One venture capitalist, the first venture capitalist, gave $5 million, and this question ends up saying, the second venture capitalist comes in after 5 years, your company IPOs for $20 million. So the first venture capitalist came in with $5 million, and then 5 years worth of interest would bring them to, 5 years worth of the interest rate that they got. Maybe I should have wrote interest rate VC1 and VC2, because these are two different interest rates. But the $5 million, after 5 years of interest, returned them $8 million, because they owned 40% of the $20 million, which is how much the company eventually cashed out for. So the second venture capitalist got a rate of 22% for 2 years. The first venture capitalist invested $5 million and received $8 million over a 5-year period, which gives them a rate of 9.8%, but that was for 5 years. So the question is, which one did better? It's the judgment call, right? I mean, is there I don't think I took any points off if you gave one of the two answers, but what is like a discussion about this? Which one did better? And it kind of brings in the topic of duration, and duration shows up not only in bonds, but really any investment. What percent you get and how long it goes for, those two combined give you a picture of how good your investment did. So the first venture capitalist made $2 million, and the second one made $3 million. So the first venture capitalist made more money, but it took more time. So we have this percentage, but this is the annual percentage. If you were able to get this for 5 years, would that be better than getting this for 2 years? And I guess the way you could argue it is, well, this person had the $4 million to do other things with it during those 3 years when they were not part of this company. And did they do enough that made it that choice better than that choice? So really, it just opens up kind of a discussion. Basically, we're saying the first venture capitalist made 9.8 for 5 years, the second one made 22% for 2 years. It's debatable which one's better. If you had to be one of these two people, which do you think would be better? To make $3 million in 5 years or make $2 million in 2 years? I guess.
Yeah, the 2 year.
Well, then you'd have 3 other years to do something else, to try to make another. If you spent the other 3 years making more than $1 million, you'd be better off. If you spent those other 3 years, if you invested in some other company that went under, then it'd be a lot worse off. But you'd have to take those other 3 years and do something that makes more than $1 million to have been better off. But that's not part of the question, so we don't. It's a little, it just opens up a discussion. Who was better off? And then the question is, how much did you receive for your 5 years of work and the value of your idea? And you ended up with 30%. So the 30% came from the fact that the first venture capitalist took 40, the second one took 30, and leaving you with 30. And the company IPO'd for 20 million, so you ended up with $6 million. Okay, so this is kind of, there's not too many ways to ask this question, but it's, you have, an initial amount, it should be 1,100, right?
Yeah.
Oh, okay, I'll change that. So basically, you're starting off with a present amount, you're adding interest, and then you get a new amount, and then calculate what the interest amount is. So with annual compounding, it's the interest rate on a per yearly basis. So that ends up being exactly 10%. If it's done semi-annual, then we have the interest rate divided by 2, but it gets added on twice. And then we say 1,000 equals this equation. And then we can calculate backwards what the interest rate is, and that's a little bit lower. So because the interest rate was a little bit less than 10%, it was added in twice. So then if we did monthly compounding, then it's the interest rate, should have brackets around here. Right, it's not the numerator raised to the 12th, it's the whole fraction raised to the 12th. So this is I over 12 raised to the 12th, and set that, the present value, to the future value, and again, figure out what the interest rate is. That should, because there's more compounding, should make it a little bit lower. And then in the continuous case, would be slightly lower than that. So it would end up being 1,000 times e to the I times 1 for time equals 10,000. So you get slightly different interest rates depending on how often it gets compounded. Okay. Okay, so now in this case, we have a 5-year bond with a yield of 11%. So we're being given the yield. Usually we're asked, what is the yield? But now we're told, here is what the yield is. So it's a 5-year bond that has a yield of 11% and it pays an 8% coupon. So right off the bat, just for future questions or questions like this, if its yield is 11% but the coupon is 8%, what does that mean? You bought it cheaper than its par value because you're getting more than the coupon is. So that's just something like, before you even see what the question is, kind of just know that. You know, if your yield is 6% and the coupon is 8%, then you overpaid the par for it. Okay, so now the question is, what is the bond's price and what is the bond's duration? So again, the duration is, just like a quick review of what a duration is. The duration is how long are you getting the interest rate you claim you're getting with the bond. Now the duration of a bond that is a 0 coupon bond, where you pay money today and then receive one payment at the very end, its duration is exactly that amount of time. But if you get payments along the way, then you want to take a weighted average of when those payments are, so the duration ends up being slightly less, or maybe a lot less, than the time till the last payment. And it's kind of like the previous question, the venture capitalists. One got 22% for a duration of 2 years, and the other one got 9.8% for a duration of 5 years. The longer the duration is, the better off the bond is for you. So it's the rate and the duration that makes your investment something good. So to calculate the price of the bond, what it should pay today is, now it's kind of done backwards. You're told what the yield is. So you're getting payments of 80, 80, 80, 80, and then your last payment is 1,080. Sometimes you might see this last payment broken up into 2 parts, but it's just you're getting $1,000 and $80 on the last day. And then we're punching in, normally we're calculating what, this usually ends up being an R that we're trying to solve for. We're actually punching the 11 in, and then we're calculating what would the bond go for in today's dollars. So if you paid $868.01 today for this bond, that pays a coupon of 8%, $80 4 times, and then a final payoff. This bond, if you purchased it today, would be, the price of the bond would be $868. So if somebody sold, so if you saw a bond with 5 years to go and an 8% coupon, and you said in your portfolio you needed a bond that pays 11%, you might offer this number. And if you don't get, let's say you really needed, for some reason your portfolio needs an 11% bond in it, you would offer this number. If the sale went through, you take it, otherwise you might not offer more than that. Okay, so then what we wanted to do was to figure out what the duration is. Like it looks like to the eye this thing lasts 5 years, but you're actually getting payments along the way, and it's not the same as receiving the whole payment at the end. When we get this $80, we don't gain any more interest on that $80. Actually, the burden falls on us to take that $80 and go find something to invest in. But if we didn't invest in, just threw it in the bank, not threw it in the bank, if we put it under our mattress and gain no interest on it, then what would this bond be like? It would be like it's making 11%, but it doesn't quite last 5 years. It lasts a little bit less. So we want to figure out what that little bit less is. So we're taking all of these payments and then taking a weighted average of them and dividing that by the overall price of the bond. So it ends up being effectively like the bond lasts 4.25 years, or a little more than 4.25 years, at 11%. So if you were a bond portfolio manager and you said to yourself, I need to find a bond to add to my portfolio, let's say some bond just expired, and the one that just expired was paying 11%. So you go out looking for a bond that will pay 11%, and you want to know, when am I going to have to buy another bond? How far in the future, when this one expires, how much I have to replace it with another bond? When will it expire? You have to treat it like it's going to expire in 4.25 years, not 5 years from now. You don't want to just sit around as these payments are coming in, and do nothing with them, you wanna be prepared for the fact that 4.25 years from now, you're gonna need to purchase another one. Don't wait 5 years, if your goal is to maintain that 11%. So there's the idea of, two, I guess, things to look for in a bond is not only what is its yield, what is it paying, but how long will it be paying for. Obviously, if it was made one big payment, half the term, and then the other final payment the other half of the term, the duration would end up being like 75% of what the time is left. So for example, if you had a bond that lasted 2 years, but it paid off half the debt the first year and then the final half the second year, its duration would only be like an average of the first year and the second year would be about 1.5 years, something in that neighborhood. It's not the same as getting the whole payment at the end of the 2 years. Okay, so then, I know it's kind of it almost seems like it's not so intuitive why we calculate the duration of a bond, but I was kind of hoping the next part of the question would point that out. So, suppose this bond's yield all of a sudden went down 0.2 of a point, went down to 10.8 instead of 11. What would its new value be? So if you just plugged in the brand new interest rate and figured it out, you would, this is basically a repeat of part one, just with a different interest rate. So this would be the new price of the bond, and then part D says, consider doing this. Instead of doing this recalculation with the new interest rate to get the right number, why don't we just say, let's take the price of part A, if it was an 11%, and then subtract off the amount we lost because of the 2% drop. So we're saying, let's just take that price at this interest rate, and for a period of 5 years, just subtract that amount. So what this calculation was doing, did that kind of make sense that that's what I was trying to do with this calculation? Instead of recalculating the whole price of the bond, I was saying, we already have the calculation at 11%, let's just take that number and subtract off 2%. Yeah?
If you make the 868 negative, it'll come out to like really close to what the actual bond price should be. Like,
Well, what, this minus sign?
like a minus sign with the first 868, like a negative 868.
Here?
Yeah, it would make it 876, which is close to the actual bond price. If you were to add the 7.388 to the 868, it would be close.
What's the 7.3?
For the change in the bond price,
Right.
like if you add the change in the bond price,
This calculation?
yeah, if you
Yeah.
add that to the original bond
Right.
price, that would give you your new
But where would you get this number from?
from change in the bond equals the negative bond price times duration times change of the yield.
Oh, yeah, but you're using this duration.
Yeah.
Right. Yeah, so that would be the correct way to do it.
Right.
That would work too. What I'm saying is, what I'm basically doing is, instead of using this duration, I was using 5.
You're using 5.
And like intuition might make this formula look like it makes sense. This formula is basically saying, take the bond at 11 and then subtract off 2% for 5 years. 0.2%.
Right.
For 5 years. You would think that this number and this number intuitively should match. You think you're calculating the same thing.
Mm-hmm.
So basically, this is the right way to calculate the bond price. This should have also worked. Just take the price at 11% and then subtract off 0.2% for 5 years. And we'd end up with this one. And the reason is the duration wasn't right. The durations didn't line up. So I was kind of just hoping this would get across the idea that the duration of the bond was not calculated correctly. It would actually be if you put the 4.2, yeah, actually it's the same exact formula. It's just I'm replacing the 5 with the correct duration, and then we get the correct price. So it's basically saying that 2% change doesn't get applied for 5 years, it gets applied for 4.25 years. and then you'd have the calculation, right? So I was kind of just hoping this would, not intuitively, but just point out that the intuition that the bond is, the bonds, the time at which you're getting that 11% is not 5 years. It's not the same thing as investing money, waiting exactly 5 years, and then getting all your money back. It's not the same thing. If that was the same thing, then those two answers would have come out correct. Okay, so here's the Ford Motor Company selling a bond at a premium of $900. The par is $1,000, the coupon is 6%. There's exactly 2 payments left. Okay, so what is the yield to maturity? We could just say it's 1,000 times the interest rate divided by the current price we're paying, which is $900. So it's 6.67. That's not, I'm sorry, not yield to maturity. That's the annual yield. How much are we getting per year, considering what we initially invested? So we paid $900, and we're getting $60. 6% of 1,000. We're getting $60 every year. So that ends up being 0.0667. What is the yield to maturity? The only difference between the yield to maturity and the yield, the annual yield, is we're adding in the difference that we get at the final payment. We paid $900 today, and we're getting $1,000 in the future. Let's take that additional extra $100 and just amortize that over the remaining payments. So we could end up saying the amount, we're going to get $60, and then we're going to get $1,060. And one is, I guess they should have been R's, not X's, because it ends up being the interest rate we're solving for X. So 60 is 1 year from now, and the 1,060 is 2 years from now. And we want to say what interest rate will make that equal to our current pay-in of 900. So the yield to maturity ends up being 11.9%. Okay, so now then this next question is also kind of a, it depends on how you look at a question, but what interest rates would make this a good investment? Well, if you're just saying that it has to be higher than the current interest rate, that's kind of true, but that would mean the Ford Motor Company should be just as risky as the bank, and the bank theoretically will never go away. You know, the textbook always refers to that as the riskless rate. You couldn't lose that. And the Ford Motor Company might go away. So you're getting whatever the yield to maturity is minus the current interest rate. That's how much better it is for you to buy this bond, but the company may go away before the 2 years are up. And in actuality, the companies very rarely go away completely. If a company files for bankruptcy, they have to go to a judge, and the judge will say, all right, you have to pay, of all the people who have bonds, you have to pay 70% of whatever you owe them. You know, it's never zero. I shouldn't say it's never 0%, but it's rarely 0%. When a company files for bankruptcy, they go to a judge and say, we have this much assets, we have this much debt, we can't pay our bills anymore. And the judge will say, all right, sell off your assets and pay the bills, and could end up saying, you know, you only get 60% of, the bondholders would get 60% of whatever's owed to them. So for example, if the par was 1,000 and the company went bankrupt, you might just get a check for $600 and you're told that's it. You don't usually get zero, but. So basically, the gain to you is the yield to maturity divided by what you could just put it in the bank and get. But now you're taking on the risk that this company might not pay off the whole bond. So figure out how much extra you want to take on that risk. Okay, so let's see, these I'll just go through real quickly. I mean, I think these are all kind of straightforward, but we have a European option on Microsoft for $3, and the stock is currently selling for $42, strike price is $40. Under what circumstances does the investor make a profit if the price goes above $37, because they get everything above, let's see, they're paying $3, right? They're selling it. They're paying $3, and they owe money. if it drops below 40. So the first $3 below 40 is just gonna eat away the $3 they got originally, and then everything below that is a loss to them. Okay, under what circumstances would the option be exercised? It's a put option, so anything below the strike price. What is the most amount of money the investor could lose? If Microsoft went down to 0, they would owe $37, and what is the most you can win? Selling an option, the most you can win is the premium. Collect the premium and then just hope you don't lose money after that. Okay, let's see, the next question, investor sells a share of IBM for $100 and buys a call. And with a strike price of 100 expires 1 month from now, neglecting interest. Under what circumstances would you make a profit? When the stock beats 95. Because they're paying out $5. Investor has a share, buys a call. If the stock is below, under what circumstances does the investor make a profit?
They make a profit 95 and lower.
Right. They're selling a share?
Yeah, so they're short and they're buying.
Okay, yeah, because they're
buying.
shorting it, so, and they're buying for $5, right, so yeah, so when the stock is below $95, under what circumstances will the option be exercised? If the price is below, what option is it?
Buying put option.
It's a put option?
Yeah, buying put option.
For what, 8 or 7?
No, it's
For 8,
short stock and buy call.
Yeah.
It's same.
right,
Same
okay,
buying put option.
okay.
Same.
And then, what's the most amount of money the investor could lose? It would be the $5 they paid, and the most money they could make would be the $100 minus the $5. This is an investor borrows $20 and buys 2 different things with the money. So they're borrowing $20 from the bank. The bank, they have to pay the money back at 5%. So a year from now, they would owe $21 to the bank, no matter what happens. And then they're taking that $20 and they're buying a call option for $14 that expires a year from now. And they're buying a put option with a strike price of 95 for $6, and the current price is 100. So no matter what, this person owes $21 a year from now. What do they have to do to break even? Under what circumstances would they make a profit? If either the call or the put pays more than $21. So in order for the call or the put to pay more than $21, the strike price on the call is 105, so it has to be more than 126. And for the put to pay more than $21, the strike price is 95, so 95 minus 21, 74. If the stock price goes less than 74 or greater than 126, this person will be able to pay back the money to the bank and keep some profit. And if it's between those two, if it's greater than 105, they would still exercise the option and get some money, but they'll end up taking a loss. Okay, under what circumstances would the options be exercised? If it's greater than 105, the call will be exercised, and if it's less than 95, the put will be exercised. And what is the most amount of money the investor could lose? You could either say $20 today or $21 in future value, which is the same thing. And what's the most they could win? If the stock price went down to 0, then on the put side, they could win everything below 70. They could win as much as $74. If it went off to infinity, they would get infinity. So it's unlimited.
I just had a question on number 8.
Yeah?
For B. I thought, wouldn't the option be exercised when it's greater than 100? Because it's a call, you're buying a call, and you would exercise it when you profit?
Your bu-
Buying call.
Buy
and
as a call.
Short. The stock is put option. It's buying put is the buying put is short stock and buying call.
Yeah, but
Yeah, so because this is a call, right? It's a call, buys a call on one share of IBM. So, yeah, so this would be, yeah, that would be, sorry, that would be greater than 100.
yeah.
Right, sorry. Yeah, change that to greater than 100. Okay.
But
Okay.
I'm not sure, but the number 8,
Yeah,
the investor short stock and buy call.
right, but it's just asking when would the
Option.
option be
Yeah,
exercised?
Just option.
Just the option part.
Because you can lose off of the stock when, but you can, you know what I'm saying?
Yeah.
You can still gain on the option.
Just option.
Okay, so now this next one, suppose we have a future, want to enter a 6-month contract in the future. Okay, so this is basically a common futures problem. The only difference is that there's a cost to the person who's holding on to the commodity. It's not like a share of stock, it's now something that takes up space or needs to be protected or something like that. So some of the commodities that people buy futures on have a cost to hang on to it. And you're having the person who you're going to buy it from pay that cost. And they're gonna wanna make you pay that cost. So it would end up being, so it's a 6-month one, so that makes whatever the interest rate has to be multiplied by the amount of time, which is a half. That's the only thing new there. And then the cost of this thing, which ends up being $1 per month,
Yeah.
you could actually, so this is kind of a lazy way of doing it, it's just saying it's $1 a month. I didn't calculate the interest in.
So you would discount that by.
Right, if you wanted to, you could discount those, in other words, instead of making the assumption that it's $1 a month, you could make the assumption that it's slightly less than $1, so that by the end of the year, with interest, it would cost $12. So this might actually be a number like 5.92 or something like that. You know, what is the cost in, if, yeah, well, actually, so we're not saying it would cost $6 for a half a year. It would be a little bit less than $6 because that doesn't take into account compounding. But anyway, this, just for the point of this question, this was close enough. So, what we're basically saying is, this would be the future if there was no cost to hang on to it. And then we're adding, I think someone may have subtracted the cost, but, so the idea was, we want to take the, if we use this price, that would be what they would exchange it for in the future. And then the person who is selling the thing is incurring this cost, so that person wants to make the buyer pay that cost too, so we would add that cost in. Okay, a 1-year forward contract on a non-dividend paying stock, so it makes things a little easier if it's not paying a dividend, because now we'd have to amortize those costs out. Okay, so basically these two parts of this question was the future price, 1 day, okay, so basically the spirit of these questions, these two parts of the question is this. If the stock price of the underlying commodity goes up 1 day, how much money should the person who was affected by that, you know, one person's gonna pay the other, what should that amount be? So if the stock price went up $10 in 1 day, the following day, what should happen? So you could calculate what the new future price would be compared to what they originally thought what the future price was the day before the stock price changed. And then take that amount and subtract interest back to today, and they pay that amount today. That's one way to do that. That should almost always be the amount of the change. There's only one day of interest missing from those two amounts. So, kind of intuitively, if it went up $10, you would think that it would go up $10 also. But they might get a bill for $9.99 because it went up $10 and then one day later, it's one less day of interest to add on, so it might be slightly less than that. Now, the second question was 11 months later, so now there's only 30 days left, or 1 month till this thing expires. And then if the future price with 30 days to go goes from $150.62, now with 29 days left to go, it drops down to this value. That's in future values, and if you calculate back to 1 month, you would get something in the neighborhood of $10, slightly more than that, $10.06. So then this last question is basically saying, so this is for a forward contract. The forward contract, at the end of the year, as they're paying each other, as the year goes on, at the end of the year, what would, if the stock price was exactly the same as it was at the beginning of the year, meaning no interest was added? Did anyone think that implied that the interest would be added? Thought one answer came. Did someone answer no, no change? Did you think the, you think it was, what was the interest rate, 5%? Like it went from 100 to 105? And therefore,
I actually didn't even add in the interest rate.
okay, I just thought if maybe you thought the question meant exactly the same, like exactly the same including interest, then there would be no change at the end of the year. But, okay, but anyway, so if someone signed this contract for $100, was it? Yeah, $100, a year goes by and they agree to exchange at 105 1 year in the future, then there'll be a $5 loss to one person. Okay, so then this question was, this is kind of a market data question. I think this was last year's question, which is why the stock price is very different this year than it was last year. And I think one of the questions didn't even make sense, but anyway, so it's, what's Microsoft's symbol? It's MSST, what exchange is it on? It's on NASDAQ. Does it pay a dividend? How did you guys find that one? Did you go to the,
Dividend?
yeah,
You can find that anywhere.
most websites just give
Yeah.
that out, okay. You didn't have to go to Microsoft to find out what its dividend
There's
is?
two different dividends too.
What's that?
There's
Oh.
two different dividends.
Oh, okay.
Dividend rate and the dividend yield.
The yield is just the amount of dividend divided by the price. And then.
Okay. So, and that's what they post, both of those?
Yeah, yeah.
Okay. And then, what is the price of a November cake is 40? Were they selling for 1 cent? Or is that what it was listed as? It always has to list something greater than 0, because then
Yeah.
people say, I'll take 10 million for free, but it's probably not even worth 1 cent, so. But, okay, actually it makes for an interesting question, like you might look at that and go, wow, 1 cent, I could buy this thing, but the chance it's gonna go down to 40 by November is not very good. You'll be losing a lot of 1 cent, so. The price of the December, there was none of these were listed? Did anyone find any listing for December?
December, the last one was 35.
Yeah.
Okay,
Yeah, it was also 1 cent, I think, or 35.
35 was 1 cent,
Yeah.
okay. So then are these in the money? So the expression in the money means the current price is,
Equal to the.
at the current price and strike price means you can currently receive money right now. So that's all that expression. So it's kind of what does that expression mean in the money? Why is a December put higher than a November put? That would end up being because you have more time, right? And that's what we'll get into a little bit later in the course, time and all the factors into option pricing. And then suppose this happened, it's not likely to happen, but happens on rare occasions. Suppose a November put is less than a December put. what could you do about this as far as an overcharge opportunity? And what you could do is buy the November and sell the December. No, sell the November and buy the December. And because the November is less expensive, you would make money on that transaction, and then you guaranteed never have to pay. If you had to pay pay for the November, you could sell the December to pay for it. So you'd actually pick up a fee and then be guaranteed not to lose money. That's why it's not likely to happen.
I think you wrote H wrong. Suppose November put shouldn't it be more expensive instead of less expensive? Because isn't it normally less expensive?
But for a put?
Yeah, I think it's still,
Right, yeah, good point. That should be less expensive.
no, more expensive.
I mean, yeah, more expensive.
Yeah,
Okay,
because time is still a
right.
factor, I guess.
Yeah, so that would be true if these were American style options, because if you got called in November, you'd want to sell the December
Right.
to cancel out. If they were European, you could actually lose money because you'd be stuck. You could pay up in November and then make nothing in the December if they were European options. But if they were American, then you could make one cancel and pay the other one.
Right.
Okay. Okay, and then, let's see, so this was, again, more market data. So we took, this one asked you to do IBM and figure out what its implied interest rate is. So what we did was we took the put-call parity equation and basically figured out what R is. So it ended up being R for the IBM stock was 1%. Now, is that calculated on a yearly basis? January is a quarter of a year from now, so that would be for a quarter of a year. So that would be an annual rate. So the people in the IBM put and call market for 3 months from now have an implied 0.01726 interest rate. And then the question was then pick another stock to see if all the other stocks have the same implied interest rate for that same amount of time. And it turns out that they don't. And some of them, I know some of you did, you had a lot of them, right? You had pluses and minuses and for the same period of time. So it's like for that stock, for people in the market of that stock, they have their mind is set on one interest rate. And for other ones, they're set on a lower interest rate. Lower interest rate or a higher interest rate. What do you think is, so did it make sense? It kind of looked like we expected the answers to come out the same. But is there any intuitive reason you might think they come out different? Well, besides, these markets are not very fluid. They're not like constantly changing, every second. It's like orders go through and then it might be a couple of hours before another one goes through, so they might not line up correctly. But then it could also be the volatility of the stock could affect what the implied interest rates are on those stocks. Stocks that don't change much should have a lower interest rates than ones that are a lot crazier. Okay, then this was just, I kind of threw this out as a random one. What is the 10-year US bond? Where did you find that one? Did you go to treasury.gov?
Yeah.
Or did anyone just poke around on Google? Like, how did you?
I typed in US 10-year bond yield.
Okay, and
then I clicked on the first one
and just said the answer.
yeah.
Okay. So if we did it over 2 periods of time, of two different weeks, we have a 2.1% and 2.26%. And then, okay, and then the question is which of the two would be better? So when I asked this question, I didn't know what the answer was. I asked this before these dates came up. So the rate on the 15th ended up being better. Did anyone get different answers? It's like sometimes what website you go to, they give a different answer, but did everyone get those two rates? 2.1 and 2.26? Okay. And then the next questions were, what the market cap of a company is. So again, these were just kind of, it was an opportunity to ask kind of random, commonly asked financial questions, or terms you hear watching financial news shows, and basically, what is the market cap of a company? So it's basically how many shares are outstanding, and then what is the current price? So you could look up the price, and you could also, most of those websites say what the number of outstanding shares are, and just multiply those two together, and you get the market cap from Morgan Stanley. And then I asked for the market cap of Facebook, which is not a private, which is not a public company. So if you went on those websites for like current stock price and went searching for Facebook, you wouldn't find it. So what ended up happening when you went looking for this answer?
I think Morgan Stanley's more than that. That's,
Yeah, I got 29 billion.
yeah, I got 29 billion as well.
Oh, did you?
That's what it says their market cap is.
Yeah.
On the website.
On what day?
On Yahoo. It actually tells you their market cap.
Okay.
Maybe you got like the shares, amount of shares is mixed up.
It's this price.
Yeah.
Did you have about that price?
Yeah, I mean, it's around there, so that's right.
Yeah, then the shares, I must have got some number. What'd you say it was, 29
Billion.
billion?
Seems about right, I mean, it's a pretty big
So
company.
that's like 60 times this answer, so something 60 times this. Okay, yeah, all right, good. Did everyone get a different answer for this? That didn't mark anybody wrong, did I?
No.
Okay. As long, I mean, basically, what I'm kind of looking for is just that you kind of looked, you know, you got the stock price and then some number that represents how many shares that's.
They have 1.54 billion outstanding shares.
1.5. Yeah, okay. That sounds about right. 1.5, that would be 20 times that. Yeah, that sounds okay. And then, so what ended up happening when you went looking for Facebook's market cap?
I got all different numbers. One said
Well-
20 billion, the other one said 35
Well,
to 40
okay,
billion. I got
you're
25.
saying the net worth of the company?
No, what the market cap would be if it was a public company. Then one said like 150. So then I just went with the one in the middle.
But did it say the market cap would be equal to?
Yeah, I can
Really?
find it for you right now if you want me to.
Yeah.
No,